Hello, everyone. Welcome to a short discussion about our focus here in intermediate accounting. You've already taken some accounting classes. You've already taken an introductory financial accounting, a second half of that as well, and you have learned about journal entries, debits and credits, and financial statements. And here we are in intermediate accounting. We're going to hopefully take your understanding of accounting to the next level with a greater ability to see what's happening and be able to manipulate financial statements, make them tell the story that we want them to tell, which should be as close as possible to what's actually happening with the company. So when we were first learning journal entries, sometimes we want to try to memorize all the journal entries or uh, try to focus just on specific debits and credits. And I hope that what I'm going to tell you here is that will help you is that we're focused in this class, intermediate accounting especially, on what the result is, so the financial statements and what they communicate. And we do that because in the professional accounting world, it's all about what is being communicated. All the rules from the FASB that you learned about in earlier accounting classes are focused on what is the outcome. There are almost no references or descriptions or examples even of journal entries, debits, and credits in the FASB's rules. It specifically tells us what should belong on an income statement like the one we're looking at here with Xerox. It describes when it should be recorded, how it should be recorded on that income statement, and it may give guidance on how to know the amount that should be recorded, but it's not about adding and subtracting correctly. That is assumed, but more about how would you calculate what gets included in, for instance, sales. What constitutes a sale and allows us to record it as a revenue. Fits the definition of a revenue and will belong here. The assumption is that you can build a spreadsheet or whatever tool you need to add up the things that fit the definition. But you need to have in the rules the definition of what a sale is, when it should be recorded, the timing, okay, and the amount of that sale, especially if there is something that it requires later determination. For instance, a sale that is the amount is paid later, received later based on some other condition. So it's not a set amount. Those are the types of things that the rules determine and help us then ultimately tell a story. And it's the same way with each of the financial statement. What belongs on a statement of comprehensive income? What belongs on the balance sheet, the cash flow? What is a definition and how do we know what amount we use for cash? Not in how do I add it up again, but what fits the definition of cash. And is a dollar always exactly the same, that amount? And we'll find instances where that is not entirely exact, true, that what the amount that we see, because it's going to be in the future, may not be exactly what is should be recorded to tell a accurate story about what's going on the financial statements. So I don't want you to get too caught up or too bogged down in the details of journal entries, as much as I want you to be able to picture what is going to happen. Because a journal entry is simply a change in an account. What we want to do most of all is recognize when an account needs to be changed and by how much. And then we can always go back and fill in what journal entries need to happen. So, for example, picking one on our this balance sheet. Let's say that we have in our records 850 for accounts receivable. Net, that's what we expect to collect. Now let's say that our analysis indicates that some part of that is not going to be collected, as we have talked about in earlier accounting classes, and that the 850 needs to be a different number. And we come up with a different estimate. Okay, the 850 is recorded in our records, but before we put it on the financial statements, we want to make sure that it is accurately portraying the picture of what we actually think we're going to receive. And so to do that, we change it. Now, this has already been done for Xerox because this is published financial statements, but this is the process that they would have went through before it was published. They would have considered how much was not going to be received. If there is a change in that amount, then there needs to be an adjustment or an entry, journal entry, to do that. And we just go back to our basic understanding that if the accounts receivable amount needs to go up, that accounts receivable is a asset account, so we'll need to have a debit go up, and then you'll need a credit for the same amount. Or you could be changing the allowance, which actually works the opposite. And the change in the allowance is if you want the allowance or the amount you're not going to be receiving to go up, you increase that with a credit, okay, and make it go down with a debit. So, but you need to be able to see and recognize, and the rules talk about how you need to go about knowing that needs to be changed, and how you might consider whether or not people are going to pay you, and coming up with the amount to estimate that they're not going to pay you. And that is probably more important for our understanding of the financial statements than the actual debit and credit. Not to minimize them, because when you really understand the changes, the debits and credits should be relatively straightforward and easy to figure out in most cases. That's not the hard part. Now, the other thing that I want you to realize is if there's something wrong with the financial statements at any stage before they get published, okay, any change to them is transparent, is not seen by the users of financial statements. Meaning, we could have changed it using one journal entry or two journal entries. Let's say that we determined the accounts receivable net was 830 and instead of 850. If I made two journal entries for $10 million, because all these are in millions each time, or I made one journal entry for 20 million, the result would be the same. It would look the same on the balance sheet. This is why, particularly, all of our exams, our two exams, the midterm and the final, will be preparing financial statements. You will build them. You'll have information. You'll build the financial statements telling the story. You'll have to make some journal entries, yes, because the information will change what we had from the previous year. But whether you used one journal entry or two journal entries or a combination or various things will not matter a whole lot when it comes to getting the financial statements right. That'll be the idea, the most important point. And very few points uh, are at stake over specific journal entry. More so, did you make the changes and put together the financial statements the way that they tell a story that would communicate to the users of the financial statements correctly? I hope that helps a little bit to as you face this kind of a new level of understanding of accounting, and helps you understand why we're going to do things the way we're going to do it throughout the next 15 weeks.